And, you know, all of us, you know, I'll speak for the Fed here, you know, we have a domestic mandate. Our mandate from Congress is maximum employment and price stability in the U.S., and that's what we're focused on. Everything we talk about and analyze is in the context of achieving those goals. But that said, we understand that we're in a global economy, a global financial system. So what happens in Brazil or China, what happens in Southeast Asia or South America has huge impact on the U.S. economy in terms of our employment and inflation goals. So we have to take all of that into account. We have to understand what's happening around the world and how it impacts the U.S. economy. We also need to be cognizant of the fact that when the Fed acts, it affects the global economy, understand those feedback loops and all the ramifications. But from my perspective, the important part is that we communicate our policies as well as we can. We try to act in a way that achieves our domestic goals without creating unnecessary volatility or disruption or confusion in global markets. I think we're on a good path for that. I think our communication of a gradual path of interest rates and then following that a very gradual decline in our balance sheet over many years, I think has prepared markets around the world to understand that this is being driven by the performance of the U.S. economy. It's going to be done in a very, I think, predictable and well-telegraphed way. And I think it, you know, my view is it won't be disruptive to financial markets, as the December increase showed. I mean, really, we saw no signs after that increase that markets were either unprepared or were caught off guard by that. I think most of the volatility we've seen earlier this year really was about events around the world.
Right. John, but this question, I'm trying to be careful how I pose this, because it might sound like I'm trying to disincentivize or you know, basically talk down the relevance of what you and your colleagues at the Fed do. But I've been doing this so long, I do not remember a single time in history like the past couple of years when central banks were so covered, so featured, so many sound bites were played out. I remember the days of Volcker. You know, I remember the old days of central banking when the central bank decisions would come and go and then you get on with the business of life. Now it seems like we're leaning on central banks like the savior and the be-all and end-all and the godsend. Hopefully that'll bring us manna from heaven, and letting governments off the hook. You know, I can't tell you the number of central bankers who've told me on this program, I don't know why everybody's looking to us to fix this with a little bit of rate tweaking. I mean, why can't the government do something? Fix your immigration policy, fix your labor policy, use fiscal measures. Don't depend on us and our monetary measures. We're just central bankers. We're actually really simple human beings.
Well, I think in the U.S. context, we've focused really on achieving our dual mandate goals. We obviously can't do fiscal policy. We can't do labor reforms, things like that. We look to the elected officials to do that. But, you know, we've stuck to our real focus on getting the U.S. economy back on track, getting inflation back to 2%. I think we made a lot of progress. Unemployment's come from 10% down to below 5%. Core inflation is moving back to 2%. So I think we've stuck to our mission. We've stuck to using our tools appropriately to achieve that. And we have to leave it to the elected officials, Congress in the case of the U.S., and the administration to make those other decisions. I mean, there's no question that at times fiscal policy works against the economic recovery. Other times it works in support of that. But we really need to focus on what we do and try to achieve those goals and to get the economy back on track, and leave that to others to decide how they're going to do their policies.